Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Friday afternoon, we have Mark Marex, Director of Index Research and Development at Nasdaq Investment Intelligence, to discuss how the Nasdaq-100 historically performs during rate hike cycles. Mark, it's great to see you as always. And I think it's a question that a lot of investors are asking because we've seen how rising interest rates has impacted the index, at least in the short term.
Yeah, Joe, great to be back. And I think that's the topic everyone's trying to figure out right now. Past month or so, we've seen kind of renewed concerns from investors about just how high rates have to go to get this inflation problem under control.
Yep, and we can see in your first chart here the divergence of when you look at the rate hikes and what's happening in the index.
Yeah, so really the only good example that exists as a comparison over the past decade and a half was a 3-year long cycle that got going at the end of 2015. You could see in the blue line there, it's a very kind of gradual, slow, incremental step up in the rates, with the Fed hiking by about 25 basis points 9 times through Q4 of 2018. And the index did fairly well during that entire time, right? These were gradual, well-telegraphed hikes. It was only when you got into Q4 of 2018 when the pace of hikes had gotten to be maybe a little bit faster and people were unsure where the Fed was going to pause, that we had an actual bear market develop in the Nasdaq-100 to drop 23% until kind of we heard from the Fed that they were going to start pausing their hikes. That's in fact what they did in 2019, and towards the end of 2019 they started cutting again. So you can see in that scenario, the green line, which is the index price, pretty small blip on the overall long-term bull market that we've been in, was one of the best buying opportunities for investors probably in the history of the index, because nothing fundamentally really changed all that much, and you had this bear market giving you a pretty compelling buying opportunity. It's hard to really compare to this time around. You can see that blue shaded section all the way on the right. The step up in rates has been much faster, much steeper as well. We've already hiked by 225 basis points this year. We're pricing in another 75 to 100 bips next week, and another perhaps 50 to 100 bips in December. And that's why this bear market has been so prolonged year to date. But really the level of declines have been pretty similar. I think year to date now we're sitting at around down 27% after a big kind of correction downward since mid-August. So that's kind of what people need to keep into context, is that we've been here before. It's just that the pace of hikes has been very different this time around.
And Mark, what if we take a look at what happens with rising interest rates in the fixed income market?
Yeah, so this is not something that really was that much of a concern last time around, or really hasn't been nearly as much of a concern as it is now for something like 40 years. You see the dashed lines, those are all the different maturity levels of the US Treasury curve. All of them have gone up from anywhere from about 1% to 2% yields at the beginning of the year to well over 3%, in some cases approaching 4% now. We had a bit of that pause at the beginning and middle of the summer, but now we're hitting new highs for a lot of these, if not all. And that's caused a renewed downdraft in fixed income returns, not just in the US, but globally, really shaping up to be one of, if not the worst year on record for fixed income investors. And that matters for equities, right? Because if you've got a lot of 60-40 investors there with a sizable fixed income allocation, if fixed income is not acting as a hedge when equities are struggling, then those investors don't have any gains to reallocate when they rebalance. They're basically losing on both sides of their portfolio. So very important, to find a ceiling on rates which we thought we did at the beginning of the summer. Seems like we're not quite there yet. So we'll be following this closely for the rest of the year.
Yeah. And Mark, one thing that we've been discussing a lot, not only on our show, but in other areas of financial media, is how stocks that have big weightings, whether it's a Nasdaq-100 or other index, perform and how it impacts the movements of the overall market. So if we isolate FATMANG, which you have identified as the heavyweights in the Nasdaq-100, how are they performed relative to the index overall?
Yeah, so I mean, these are the top 7 names. They've been the top 7 for most of the year, about 50% of the index. And it's really, it's really a tale of two different scenarios with these top 7. You could see at the very bottom, NVIDIA and Meta, formerly known as Facebook. They are doubly as bad as the next worst on this list. Meta, Facebook, of course, struggling from 2 fronts, advertising being their only business at this point, and one that is pretty sensitive to economic growth, as well as the fact that they're embarking on a decade-long, very, very expensive, capital expenditure intensive project to create the metaverse. That has just not been a good recipe for them this year. And so I think it is important to distinguish what's happened with Meta from the rest of the kind of big 5 group that we usually talk about in large cap tech, with Apple and Amazon and Microsoft and Google. Those are all performing, at or around what the market is doing. None of those are really underperforming what the NDX has done year to date. NVIDIA, the other one struggling here, I think that's more of a valuation story in that it probably got ahead of itself more than it should have. But also we're seeing slowdowns in certain areas of the semiconductor industry. So, important to keep in mind where your exposure is, where the pain is coming from. It is not evenly spread out. There are pockets of strength and pockets of outperformance. Tesla and Apple here are down only 14%. That's about half as bad as the overall index is down year to date. So important for those kind of other big players to keep holding up. I think to keep a floor on where the index goes for the rest of the year.
All right, Mark, great insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.